The Crotchety Old Men podcast is not a registered investment, legal, or tax advisor or a broker-dealer. All investment financial opinions expressed by or on the Crotchety Old Men podcast are from the personal research and experience of the owner of the site and are intended as educational material. Although best efforts are made to ensure that all information is accurate and up to date, occasionally unintended errors and misprints may occur. Before you invest or make any investment-based decisions, consider your own personal circumstances. You should do your own research and seek advice from a financial professional.
Hey, it's another fun day with the Crotchety Old Men podcast. Hi, I'm Gary Smith, co-host for today's episode with my partner in crime. In the studio with me today is George Crumley. Good morning, George.
Hey, Gary. Morning. How you doing?
I'm doing great, man. How you doing today?
I'm good, man. It's a little overcast, but it's what I call fall. I like fall weather, so hey, I'm happy, and nothing could be better.
Hey, well. Well, you know what, man? Michigan weather changes all the time, and however, today is very nice and sunny, and there's a little chilled out there to the air, but today may be our last 76-degree day. It's proclaimed forecast rather to be 76 today, and I'm looking forward to it because tomorrow that bad boy plummets.
Understood. I definitely understand. Understand. So, what are we talking about today, Gary?
Well, I was
Let's get it on.
George, that maybe we could talk about investing in single-family rentals, single-family homes. You know, we're seeing a lot of that happening in the market today. People are looking for a safe place to put their money. You and I was kind of chopping it up a while back about, the bonds are not doing as well, volatility in the stock market, crypto is up and down, et cetera, et cetera. So where do you put your money at today in today's market and be able to get a decent yield? So what do you think?
Yeah, I
Let's
agree.
talk about that.
I agree, Gary. I always say is it's never a bad time to buy a house. Regardless if that's your main residence or it's a investment property. But when I look back in the day, I've bought houses with interest rates 10% and above. But and obviously interest rates aren't that high. They are higher than we're accustomed to. But you can't let that scare you as far as investing in yourself and investing in a long-term type of investments and holdings. So yeah, I think rental real estate is a great thing to look at right now because there's so much uncertainty in some of the other investment tools. So yeah, let's kind of chop that up and talk about that today.
Okay. Yeah. And let me put this caveat out there, caveat emptor, that while I'm a strong proponent of commercial real estate, I think the single family rental or single family investment real estate is a significant opportunity for those who, as far as the price range and as far as your market and things of that, your capability, what I'm trying to say. These the average investor's reach, if you will. So, hey, George, let's just dive right into it. What do you say, man?
All right. Let's get right into it. Like I said, we want to make sure people understand this is our opinion, and any investment that you make, you want to make sure you go out and do your own homework. But, from our history, our current knowledge, basically, and what we've experienced before, this is something that can really help you and here again, build a nest egg for the future.
Absolutely. When you bought your first rental property, let's start with that. How did you go about it? Can you kind of, give us a little process?
Well, when I bought my first rental property, the first thing I thought about is, proximity, which was I wanted it to be somewhere close. And here again, I bought not all of them, but I bought my first several rental properties in the city of Detroit. And I emphasize city, it wasn't in the suburbs. We eventually kind of extended ourselves into the suburbs, but we stayed close to the city, close to basically our, the home that was we originally lived in and grew up in. And I say we, me and my brother, we basically did the initial investment. But it was like I said, proximity, how to get to the home. We wanted to make sure that it was we didn't have to drive a long way to get to it. So we ended up buying two family flats actually,
Hmm.
which it would have been 4 units, and with the assumption that as long as one is paying, the other one it would take care of itself. So, but with the optimal, you have tenants in both up and down. You can look at profit, but more so we were looking at what getting in a situation where the rents would pay for everything, and that would be including the mortgage, which we did get a mortgage on the home. As far as the water bill, which the owner is always responsible for the water bill, and any initial fix up, which in this situation, there wasn't a lot involved. I think it was some paint, new carpet, wasn't anything major, no furnaces or anything like that. A lot of that stuff came later, but the initial outlay to get in wasn't that difficult. We looked at, that initial investment as far as numbers, how much money it would cost us, and it wasn't that much. But we're talking about back in the early '80s. Okay, obviously a lot of that has changed, but it's still the same process to go, to get into something. Those are the kind of things you want to take a look at.
Were you able to get the
So
mortgage before you acquired the property, or was this mortgage acquired, built it up?
no, we were able to get the mortgage prior to purchasing the property. You know, I, Obviously, one of the things you always hear me talk about is having good credit. So I had, excellent credit. So it was no problem getting the down payment as far as also getting the credit and getting it approved. Um, I want to make sure that we're talking in today terms. Obviously, um, property is a little bit more expensive than it was when I was doing my deals. But to talk about that, I want to make sure people understand there's still opportunities out here. And sometimes you have to look at properties that are not necessarily in the city in which you live. I talked about proximity was important to me, but with today's market and you're trying to get into investment property, proximity may not be the number one issue. So, like for example, you may live in Atlanta, but you may want to look at houses in Detroit or Ohio or places like that because there are still deals. And you say, how do I manage something like that? Well, I mean, there are management companies out here that can help you along with these kind of deals, but it's all about you know buying an airplane ticket to get to Detroit to do the work may make it more cost effective as a part opposed to buying a piece of property in Atlanta because of the fact that looking at even foreclosures. I get the texts every day, and you're talking about nothing less than 200,000, 250,000. These are complete, fixer uppers. So that's a lot to invest. So that's something that you want to look at. So when you're looking at property, say in a Detroit, you still may be able to get something for 70, $80,000, which when you look at that, the fix up, the cost of an airline ticket, it may be, you know, more advantageous for you to go that way.
Mhm. In terms of good stuff, too, good stuff. In terms of identifying when going into or selecting a property with the intentions of renting it out, um, are there any must-haves in terms of time wise? Uh, and I guess what I'm looking for is that should we as investors look for what's the minimum amount of money I want to put in my pocket or put in the bank after the rent has been paid and my mortgage has been paid and taxes and insurance or whatever comes out of that? Do you use any type of bottom line number, or would you should suggest that for a new investor? If the rent is $1,000 a month, and you say, well, I want out of that $1,000 a month, the net to my pocket, the net to what I'm going to be able to put in my savings account, bank account, what have you. I want to make at least $200 a month. Is there any benchmarks that you would recommend we take a look at if you're going to do this, as opposed to just doing it willy nilly?
Well, I think that if you have a goal, it's just like any other budgetary thing when you're initially calculating the numbers and the cost of investing in that property. You want to itemize everything. Like I said, water bill is normally what you're responsible for, the mortgage, the insurance, if there's any upkeep as far as grass, or if you're in a climate where you need snow removal or things like that. So, you also want to include, that $200 to reinvest in the property. So I would make that a line item, just like I would make anything else. So you want to consider that when you're buying the property, as far as what your delta is for how much you're going to put down, how much the monthly is going to be, how much can get with rent. So the interesting thing about that is you can go online and just Google the average rent in a particular area, and it'll let you know what that is. So you kind of have a basis for what you can charge for that particular property. Now, depending on the enhancements that you make to that property, meaning upgrade the kitchen, upgrade the bathroom, new carpet, new paint, and those types of amenities, you may be able to charge more or less. So that's going to dictate, where you are as far as a delta once you get to that point where you say now it's ready to rent. When you look at the real life adventure, I'll say adventure of investing in property, it's totally different than your HDTV type of scenarios. I mean, they glamorize investing in property, and trust me, it's nothing like that. When you make a decision to tear down a wall of a house that's, 50 to 60, 70 years old. And most houses are. I mean, you're not renting out, you're not buying houses that were built in the 2000s, sometimes not even in the 90s, that are rental properties. Sometimes, I mean, you got to look at houses that were built in the 80s and before. That's where your deals are going to be. So when you start talking about tearing down a wall, because I know that's one of the favorite things that these HD TVs like to show is, the lady slinging the sledgehammer and tearing down the wall. Man, that is like opening up a can of worms. So I just want to make sure you know that is not a common event. You don't just go in and tear down a wall. You got to have a heck of a reason that you want to do that. And especially when they're talking about a lot of California properties, because they are small properties. And you're talking about, well, I'm going to make this room bigger and I'm going to make it an open floor plan. If this is your first property, that's not the direction you want to go in. You want to get into that property with the minimal type of upgrades as possible. Like I said, kitchen, bathroom, new carpet, paint. If you can get away with that, you're batting 1,000. So, that hopefully that answers your question. I know it was a kind of a long-winded way around it, but that's the way I would go at how I'm going to get to my delta as far as what I'm going to put away on a monthly basis.
That's excellent, George. I tell you, that's excellent. And I like the way you put it. I'm thinking that if you have a budget to invest, a certain amount of money to invest, you have several options, and we kind of talked about that earlier. I'm just going to use $100,000 as an example because you need to pull that out of a self-directed IRA or for whatever. But here's where I'm going with this. If I got $100,000 and I know that bonds are only paying 3.9% return on that, so 3.9% of $100,000 is roughly $3,900, and so that would be my return on that bond. So, well, what can I do better? Well, sure, there's safety in that bond. You're going to be tied up for 10 years or what have you before that bond comes to yield to maturity. Or I could go this route and take that same $100,000 and buy an investment property. And I think to your point, it depends upon what kind of investment property you buy. Are you buying just a single family property, or are you buying a duplex or a fourplex? And to that end, if you're buying more units, then obviously you get more units for your $100,000, obviously. So you should be able to get a modicum or significant return or higher return on that same dollar as opposed to putting it in a bond. So going back to this, where's your your renovations and things. For a newbie, how would a new person know whether or not they're overpaying for a kitchen or overpaying for a bathroom or putting money into cosmetics that's not going to add any value to the property, and then be trying to charge $2,000 a month in an area that you can only get 1,500 in? How can you avoid that? Because George, that kind of stuff happens, right? So how does an investor avoid that, especially a new person, coming into, and especially if you're talking about buying a property that's out of state?
Well, Gary, I wish I could say there's a cookie cutter approach to this, but
Mm-hmm.
it's going to be doing your research.
Mm-hmm.
Um, if I had to buy a house today, okay,
Mm-hmm.
knowing where I am, um, personally, I would look at like a Detroit because I'm familiar with that. I still have rental properties in Detroit, even though I'm in Atlanta. But the first thing I would do is I would look and calculate how much I can get for a rental property in that area, from a monthly perspective. How much rent can I get? That's the first thing I
All
would
right.
look at.
All
And
right.
that would kind of solidify if this is the area I want to go in. Another example is uh, buying a house in Atlanta. I was talking to a gentleman yesterday, and he bought a property in Atlanta, which in the city of Atlanta. And I think he said he paid. I think the houses were going for over 400,000. Now, if that's a house that's already uh, ready for a move-in home buyer that someone's going to occupy, that's pretty good. But if you look in that same area, you may be able to find something that is maybe half of that price, which would get you somewhere around 260, 280. Okay. You put down 100,000, you've got about $180,000 mortgage. Now, on a $180,000 mortgage, you're probably talking about 30-year mortgage. You're probably talking about taxes, insurance with the current interest rate. I'm going to estimate you're probably talking of somewhere around uh, probably $2,000 a month in rent. That's an average. I mean, not in rent. I'm sorry, $2,000 a month as far as a note goes. Um, no, no. What am I saying? I'm sorry. I'm sorry. I'm sorry. You're probably talking about around $800 a month um, in a mortgage payment. So if
Mm-hmm.
you're talking about around $800 a month in mortgage payment, then um, you can look at rent. So I can maybe rent that for double that, somewhere around 1,700 $1,700 a month, which should basically pay for all of your expenses and allow you to be able to put something away as far as reinvesting in the company or reinvesting in the property, or as far as being able to put something in your pocket.
Mm-hmm.
That's what I would think you'd want to be around.
Okay, good stuff. Good stuff. Because I'm listening to you, Jordan. I'm thinking that before a person should start out in any investment, first of all, figure out, why am I doing this? Are you investing in it for financial independence? Are you doing it for long term growth, or to be able to live off of it? Because if you buy one property, it should be, if you buy another one, then buy another one. Whereas now you have a portfolio of them. And where I was going with my question earlier is that, if, let's say, for instance, if you can net um, let's say $500 a month per property. All right, and that's $500 a month after all your expenses that's coming in off that property. Then you go get you another one, and you're able to net another $500. Now you have created $1,000 of passive income, cash flow that's coming into your portfolio. So the goal is, okay, so how many of these do I want to buy? Where is it I can rent them out? And what's my goal? Is my goal to get $100,000 of cash flow, or whatever your goal is, $1,000 a month, let's say? Well, there's several ways where you can approach that. You either buy 4 single family homes and rent them out where you can net $500 each, or to what you said earlier, George, or find you a fourplex. Cases you have to live in one of them for a period of time to qualify for certain government funding or whatever. But hey, it's a good way to get that property. But now you have, even if you did have to live in one for a while, you got 3 units at 500. That's $1,500 a monthly income right there. So to leverage your way into rental properties from this manner, and to George's point, calculating all your expenses and things like that, this could be certainly another way, a lucrative way for us. And I say us as African Americans, Black people, whatever you want to call us, for us to build wealth and do it without having and having control, basically, because you're right there on the front lines. You're overlooking the project, the renovations and stuff. But more importantly, you're receiving the direct results, if you will, from your efforts. You know, so thanks, George, for that path right there. So, what
Yeah.
else should we be thinking about, man, when we talk about this
Well,
stuff?
Gary, where I'm going with this is the taxes. I
Yes.
look at the tax advantages for owning rental property just as important as what I'm going to receive on a monthly basis from a rental income. Simply because of the fact that as I go into a property, and any and all of the upgrades that I do are all tax deductible and continue to be tax deductible. So if
Mhm.
I'm buying refrigerators and a lot of this stuff, you can amortize over the length of the time that you're in the property. You can even amortize the land in which the property is sitting on. So there's a lot of tax advantages, and that's one of the things that we always talk about. Is how to get the best out of the tax code as it exists today. You're
Mhm.
not, you're not, it's not cheating anything. It's basically understanding the rules of the game and playing the game as it was designed to play. So, you have tax advantages for owning rental property. There's so many things that you can write. The taxes, you can write that off. If you're paying the water bill, you can write that off. Like I said, if you're upgrading the kitchen, if you got a landscaper that comes in every month, you can write that off. If you buy it out of state and you have to fly there once a quarter to visit your property, you can write that off. If you got meals, you can write that off. So there's a lot of tax advantages in owning, and like I said, I like those as much as I like obviously the rental income coming in on a monthly basis. So yeah, I think those are things that you definitely have to consider when you're going this way to invest and build long term investments.
Absolutely, man. I tell you that when you look in long term, that's the way we should look anyway. I believe, the long term takes care of itself. As we know, if we look at the history from in comparison of real estate to stocks, over the long term, real estate is always appreciated. I mean, after all, the old adage goes that you always need to have somewhere to live, right? And so, but we're not saying that, one's better than the other, what have you, is that you got to keep in mind that where you are in the market, it's a balanced portfolio, and it's best to have a balanced portfolio out there. So I'm not saying, no, I mean, we're not saying, do away with your stock portfolio or pull it all out and go into real estate no more than we're saying put all your real estate in the crypto coin, but you want something balanced so that therefore it doesn't matter. It won't matter whether or not we're in a down economy, a good economy, or what have you. We have to learn more and more and educate ourselves about investments. But more importantly, we have to learn to make money in good times and bad times. So whereas that it doesn't matter. Okay. And that's what we're really trying to get across here today. And in all our episodes, make sure that not only that you tune in to us, and while I got this little PSA, I'm going to stick it in there, George. We can be found on iHeart podcast. We can be on the Spotify, the website or what have you. Tune in because we're always trying to help our own create, preserve and build wealth. And what we're talking about here is just wealth building principles, another method by way which you can create wealth. Another thing, George, with the single family property as an investment, you talked about the taxes, which is very significant, the depreciation. You talk about the growth and income and things of that nature. At some point in time, it comes where now you got all your capital that you put into that property, you got it all back out over a course of however many years you have that property. Now, in passing properties on, there's probably, again, going back to this tax situation. Do you advise, I should say, or recommend that you purchase each property in its own LLC, or do you have just one huge LLC or trust in which to pass those properties on? What would you suggest?
Well, this is my opinion, and I would put them all in the same because of the fact that it makes it easier for accounting to have them, all because it's the same type of transaction. So, but I mean, here again, it's up to you, and it's up to how you want to operate as a business. You can have one entity, ABC Property Inc. LLC, and under that, you can have your umbrella of different properties listed. Um, so it's just how you want to operate. I would definitely seek um, the advice of an accountant or a money manager or a tax advisor to give you the right direction on how you want to set up your business. Because I think here again, it's not a cookie cutter approach. It's how you want you know, to set that up. And I say that because, say, for example, what if you want to have a portfolio of 5 rentals and you want to do fix and flip? So your fix and flip might be under a different entity because of the fact that that's such a quick transaction. You're trying to buy and fix it up and flip it within 6 months. So that might be a different transaction altogether. So those are the kind of things you need to look at as you build your portfolio. And as I talk about, fix and flips, you have to keep in mind that if you do that, there's other taxes that are involved. There's capital gains if you make a gain on that. You have to look at, what am I really gambling? Because we talked earlier about how we calculate how much we want to make on a monthly basis. Now, on a fix and flip, you're doing the same thing. You're calculating, I can buy this house at, $100,000, and if I put, another 50,000 in it, I can sell it at 250,000 net, I can make, about 50, $75,000. However, when you go into fix and flip situation here again, when you start talking about uh, improvements that are gonna give you that long term, that higher yield in a short period of time, um, you may run into situations where it's going to cost you more money when you start tearing out things and trying to make it like you want it to get that high dollar. So fix and flips are not a guaranteed way to invest. There's a lot of gamble in fix and flip because of a lot of the unknowns. I'm not saying don't do it, but here again, I'm saying you got to do your homework and make sure you're doing your research and making sure that's the way you want to go. Because with all that money that you make, you're going to have to, pay the additional taxes, capital gain taxes on it in that short period of time. So you want to keep that in mind also.
Right. It's been my understanding is that with most assets comes a liability. And from a commercial real estate perspective, many investors, we believe that, each property, each asset should have its own entity because of the very reason of the name, limited liability. And so to keep that property from tainting or being attached to any other properties, in the event of a suit or what have you, then that property will stand up on its own. And whatever liability comes with owning or managing that asset stays right there with that. It doesn't have any impact or effect on the rest of my portfolio. So you can have those, in those specific LLCs, if you will, and then to your point, like you said, George, if you're going to flip it, you can flip it on off. And if any gains or what have you, that's going to be attributed to that asset. Even though it's a pass through, you have these other assets and with your deductions and stuff, probably negate any capital gains or whatever tax, or minimize them. But as we all know, when we talk about taxes and things of that nature and legal entities such as LLCs, we're just giving our own little old school crotchety old man opinion. We are not giving anybody any legal advice, any tax advice, because neither one of us are an accountant or an attorney. So to George's point,
Right.
make sure you do your research. All right. But what we will share and what we have been sharing, ladies and gentlemen, is the things that have worked for us. We're not just talking about it, but being about it. And to this day, even though you retire from having, a job or doing your respective things that you used to do for money, it does not make you retired from making money. Okay. And so, yeah, you hear from the crotchety old men as we share wisdom, knowledge, and empowerment and inspiration to those out there is willing and ready to make a difference. So, George, what else we got for him, man, before we wrap up here for today?
Well, you just saying that, Gary, I'm a big fan of staying in my own lane. So anytime I'm looking at investing in any property, I'm also going to include as far as expenses is, like I said, an accountant to make sure the numbers are correct. Because I've heard about a lot of horror stories on people that get into a business and then they find out that you know they're not reaping the benefits because they're falling short on the paperwork or something like that. So I'm a real big fan of getting an accountant to do the accounting paperwork, an attorney to look over any papers that I need, and any other kind of legal advice that I need, and not trying to wing it and just do it myself because I think it's the right way to go. Because in the long run, like I said, here again, these are expenses you can write off, but in the long run, it's going to protect you. Having a large uh, liability insurance policy that's going to protect you for any kind of stuff out of the box. That's a must have. So, there are a lot of things that, we want to do sometimes on a shoestring, but you want to make sure you're doing it the right way, so that here again, like we talk about investing so that you can sleep well at night. And it's just like that with property. You want to make sure that you can sleep well at night and you've got people handling the legal aspects of this game that you may not be familiar with, so that you are comfortable with it. But I think those are things that we have to look at anytime we're dibbling and dabbling in real estate. It's not always like it is, like I said, on TV. And that's totally different. There's a lot of things that go on behind the scenes that we're not privy to, and they do that intentionally because they're trying to sell a television show and not necessarily trying to sell the investment of rental real estate. So we got to keep these things in mind. But like I said, I stand behind it. It's always a good time to buy a house, and I've enjoyed talking about this today. But I think with those things, you've got a good foundation that's going to take you in the direction of, here, what do I do with my money today? The fact that the stock market is crazy, the bonds are crazy. There's a lot of things that uncertainty in that market. Like I said, rental real estate is always a good investment, but you got to do your homework. So you hear me say that over and over again. You got to do your homework. So with that, Smitty, I'm going to turn it back over to you. I know you always got some words of wisdom for us. So what you got for us today?
Well, here's the word of wisdom for today. And when it comes to real estate, specifically investing in real estate, you make your money when you buy, not when you sell. All right. So if you didn't know before you came on the show, now you know.
Now you know. Hey, you take care.
All right. Until next.
You have been listening to the Crotchety Old Men podcast, produced in conjunction with the Crotchety Old Men Podcast, LLC. The information contained in this podcast is provided for your listening enjoyment, as well as to provide information, education, opportunity, and exposure in the complicated world of finance. You can find us on your favorite podcast platform, including Google, Apple, iHeartRadio, or Spotify. For questions regarding this episode or any other episode, please contact us at info@thecrotchetyoldmenpodcast.com or visit our website at thecrotchetyoldmenpodcast.com.